we wanted to look at last week's poll, I believe, to start, Brett, and it was in regards to the capital gains, the new proposed capital gains tax.
Yeah, so a nice and simple question. Do you think the Canadian capital gains inclusion tax rate increase will impact the Canadian stock market? 62% of our viewers said yes, while 38% said no.
So if I could just start, I voted yes. And I mean, this is just anecdotally from hearing from clients. Like I had a call with a client last week and he was literally saying that he's planning on taking profit on a bunch of these names before basically it kicks in. So, that is one thing. And why I guess I voted that way. Again, he's looking at his portfolio and he's not just taking profit and trying to avoid the tax on any names. If it's a good company, still continue to hold that good company. But again, on names that maybe are, have maybe exposure to commodities or whatnot, he has been, taking profit there. So I do think that it may impact it a bit.
Yeah, no, probably would have. If it did, it would be
presumably he's going to put that money back into the market.
Yep.
Yeah, the effect, and again, we just mentioned Hammond Power. Now, there's, we were talking pre-show. You can't show specific evidence of this, but it was the day or so after this proposed tax was put in. Now that stock is a stock where Canadians, our clients specifically who had invested in that stock over the past 5 years, it's the best performing stock on the entire Toronto Stock Exchange. It has some unique characteristics to it in that, relative to say a TD, it is relatively illiquid. I mean, it still trades in significant volume now that you can move in and out, but that if there was a amount of investors pushing the sell button on one date, it could move the stock more significantly than a highly liquid name. So on those dates preceding, the stock actually came off significantly higher still than it was a year ago, 200% plus, but came off. It's since recovered to a degree, but I mean, you could have seen that with some people looking at, like there was literally people, and we talked pre-show, looking at $1 million gain in the stock, for example. And if you thought you could save 100,000 plus in taxes, or in that range, then you may be making a decision. Now, I'll talk about this in a second in a segment. You should never make your decision really based on tax reasons. This is a kind of unique situation. And as far as investing in a company based on that or anything, you got to look at the underlying business, not the tax behind it or the tax situation. So, but yeah, Aaron, sorry, were you saying some more there?
I voted that it would, but I also want to qualify that by saying that I don't think that the impact to the market, the sustained impact to the market based on this one thing is going to be big enough that it's necessarily going to be measurable and traceable to it. But what I think is that this is one of many things that the Canadian government does, or just Canada does in general, which I think impacts our productivity and our attractiveness as an investment center over time, right? I mean, there's a lot of things that we need to work on. Competitive tax structure is one of those things. It's one of many. So while I don't think that this one thing is going to have a substantial impact on the market, that is, I mean, certainly on individual stocks in the near term, presumably for most Canadians, a lot of that money is going to go back into the market, into other companies. But certainly I just think it's a step in the wrong direction, where I think we should be encouraging investment and not discouraging it as one of the ways essentially to, improve the productivity situation here in Canada. That's my thought. So
yeah, and there's this short-term market fluctuation that we might see, but the long-term structural issues here are whether it's more attractive to set up a tech company here. Will we have the next, Shopify? The person who's sitting in their, in their software development class right now, thinking of, developing the next greatest software company or tech company, and are they going to say, you know what, I'll just incorporate this in the US? Mm-hmm. And then we don't have the next Shopify development.
And there's a million different other things that they'll consider as well, but this is, this is one of them, right? It's one of them. So,
one that pushes them to go.
The isn't going to be the single sole factor that people that determine whether or not we become a center for investment and tech development and innovation. But it's a lot of small things that work together, and this is one of those small things. I think it's a step in the wrong direction.
And it's not just saying, oh, that person's greedy or whatever because they want to set it up in the U.S. because they'll make more, or some other jurisdiction because they'll make more. The reality is, if you're looking to hire talent, the tech sector has historically had compensation through stock options, and if that's less attractive based on a capital gains tax here, you may not be able to garner or attract the same amount of talent in that firm if you're based here. So, these are things that have long-term ramifications. Yes, the government may be able to pull in some more tax over the near term, but is this a structurally good decision for a robust economy in the long term? Again, that'll be proved out over long term. I'd argue against it.
Yeah, so I can add a couple things here. The way I see the near-term effect, I think it's going to be like an exasperated tax selling season. So normally in December, you'll start to see people sell things off for tax purposes. And that's across effectively every Western country. You'll see that to some degree. The degrees changes a bit, but that's something that you've seen throughout history. As well, just looking at the historic capital gain treatment in Canada, prior to 1972, there was no capital gains tax at all. It was tax-free. After that, till 1990, you had a 50%. Then from 1990 to 2000, you had a 75%. There was a bit of a interchange period there, but it was so. Then we dropped back down after that in 2000 for the next 24 years now at that 50%. So we had about a decade at 75%, and then it got reverted.
Yeah.
And during that time, obviously, we had that massive Canadian tech run-up, which obviously collapsed soon after. And we saw that with Nortel was obviously the headline name there. So it didn't inhibit those companies directly, at least because they were quite young at that time too. Remember, they really grew up in the early 90s and they became public companies in the late 90s. So it didn't directly inhibit them. So while I wouldn't argue against saying it, especially when it comes to the talent and stuff like that, that's, I would say, is the bigger issue is you need to have a way to attract talent within Canada. And one of those ways is obviously doing those stock options, doing those share issuances in whatever vehicle. But the capital gains tax alone is not the end all for attracting tech talent or whatever emerging industry talent. It's just one of the avenues which they can do. So the Canadian government, if that's what their goal is, which they've proven time and time again, they always say, we want tech companies in Canada, but they don't really do anything about it. They need to do something to attract the talent. Yeah. Especially when they're detracting in this manner.
Well, and if you keep going in that direction, higher personal tax rates, higher corporate rates, higher capital gains rates, I mean, eventually people throw their hands in the air and say, if I have somewhere else to start my company, perhaps I do.
Exactly.
That. I mean, I love living here, but if they're, if you're paying 20, 30% more tax somewhere or 15% more, and then, and the other the thing we just said, and you said it's very important, if you're not able to attract the talent that you need, then you can't have the business. So, or you're going to have a business that will fail. All right. I'm going to talk a little bit about a simple example. So as you have already heard in the budget 2024, the Canadian government has proposed to increase the capital gains tax for capital gains realized on or after June 25th, 2024, from 50% to 67%. This is not the tax you will pay, but rather how much of your gain will be taxed. The actual gain will depend on the size of the gain and your personal tax brackets. I'll go through an example below on this. Additionally, on the personal side versus the corporate side, there is first a hurdle of $250,000 per person of gain that will still fall under the 50% inclusion rate. At this point, we do not have any documentation showing what will officially become law and when. In fact, the government has pulled last-second reversals on several initiatives, including amendments to the firearms law. It would be great to see some written clarity, but we are in a holding pattern for now. In fact, the proposed capital gains tax changes were notably absent from the motion the Liberal government tabled to introduce Budget 2024 in the House of Commons. It appears that the government intends to ask Parliament to approve them in separate legislation. So the question is to do or not to do. That is your question here. Some individuals are wondering whether to sell assets with gains now versus after. Tax in my opinion, in our opinion specifically, should never drive your investment decisions. You want to consider the investment unto itself. Again, this is somewhat of a unique situation, but if you were planning to sell that asset, whether it be a house or an individual stock anyways, then it may make some sense depending on pricing to do it now. Now, I would say based on a high level net present value calculation using 5% after tax rate of return and currently proposed tax rates, it may be more beneficial for the taxpayer to pay the income tax today at a lower inclusion rate if the taxpayer was otherwise intending to realize the capital gains within the next 5 years. Here's a simple example. If you are in the highest tax bracket, your rough change in tax after the first 250,000 of gain will be calculated as follows. This is a very basic example. Again, 100,000, that's the amount, or just that's $1,000 I'm going to use simply here. Amount over the 250,000. Total gain here is 251,000. So the inclusion rate, 67%, that would be $667 versus inclusion rate at 50% would be $500. So difference of 167 additional gain to be taxable. So we're going to use BC here because that's where we're based. At least I'm based there. The highest BC tax bracket for 2023 is 53.5%. So additional tax on the increased inclusion would be $89.35. Many business groups and private sector economists argue that raising taxes on capital gains disincentivizes investment and entrepreneurship. I would agree. We kind of talked about this in the last segment. And they are stating it would be unwise to move. This is at a time when the Bank of Canada has declared weak productivity growth and lackluster business investment as really a national emergency. What really bothers me, I mean, not paying more tax bothers me all the time. I think there should be a reasonable amount, but we already saw that high tax bracket amount there of 53.5%. To me, that's enough tax already that you're paying on your personal income. But I think it's very disingenuous to say this tax, and the government is out there saying this all the time, will only affect the ultra rich. This is not just a quip that they're saying. They have it in print. And the government data, they say, indicates only 0.13% of Canadians. That would be people with an average income of about 1.4 million a year are expected to pay more in personal income tax on their capital gains as a result of this change. I'd love to see the actual inputs on this. They're disingenuous and I would say BS. Anecdotally, I'm just going to give you a quick example here. Real world example. My neighbor has a house, a summer house that has been in the family for 50 years. It was bought for $20,000 50 years ago with after tax dollars, I'd add, and it's now worth about 1.4 million. They don't make 1.4 million a year. He wished they made a tenth of that, I believe, but they will be affected by this tax. If you take the $1.4 million sell price on this, minus their gain minus the $20,000 initial purchase, that's 1.38 million. You take off that 250,000, 1.13 million is taxed at that new inclusion rate. 67% inclusion rate, that would be about roughly 757,000 taxable, versus the 50% inclusion rate would be 565,000. After the proposed tax increase at 53.5%, that's the highest tax rate in BC. That's tax paid of $404,000 roughly. Prior to the proposed tax, it'd be $302,000 on that additional amount. So $102,000 more. Again, that's a significant tax burden that they could be paying on that. And again, they don't make 1.4 million a year, and they're not the ultra rich. So, I mean, it really boils my blood when I hear this tax is only going to affect the ultra rich. Maybe you're saying that on an annual basis, but many people have a family asset or a summer place or one stock. We were just talking about Hammond Power. that stock for our clients is up 20,000%. There's many clients that we know have very significant gains in that stock, and they will be affected by this. They don't all make 1.4 million a year. It's very disingenuous to say that this tax will only affect the super, ultra, or whatever you may call it risk. And it bothers me because it's going to affect everyday Canadians as well. So, I mean, that should be said.
Yeah. I mean, obviously, we're not like a political podcast. We don't want to get into it too much, but it also kind of like boils my blood a little bit just that they've pulled out, or the Liberals grinds my gears. Thank you. If I was Peter Griffin. Just the fact that essentially they pulled the capital gains change from the initial budget bill, I believe. So essentially, the Conservatives have to take a stance on either if they like it or if they don't.
Seems to be some politicking for sure.
Exactly. Yeah. And it just kind of, drives me nuts or grinds my gears. But anyways, we'll leave it at that.
Yeah. Any further comments on that? Or are we good?
I would just say, like you're using an example as a house, I would say for stocks as well, is you can do a bit more structuring to your capital gain. So if you do have a Hammond Power level gain, you're planning on holding it, let's say you're planning to sell it in 5 years. So over that 5 years, you can structure your selling as, let's say, 20% of that a year, and keep under that capital gains limit of that 250,000. So then you can get that lower rate. Still, you can do that thing, that structuring with stocks, and a bit more financial planning obviously comes into that. And as well, obviously, though, if you don't want to sell the stock, don't do it just for that. It's only if you're planning to sell it anyways.
No, it's a good point. Of course, if for example, we came out with a sell on the stock because we thought not that stock, but another stock, and we thought it was overvalued. I mean, you'd want to be selling it then, and it's harder to do the tax planning structure. If we knew it was going to stay at, say, Hammond Power, $125, you could do that over time. But it's if you thought, well, now this stock is significantly overvalued, that's why we have to be taking advantage of it. But again, those are kind of one-time type scenarios that are occurring right now. But it is anytime you're paying, I just look at paying, if you're paying 50% already personally, and then we're adding to that, again, the capital gain is after tax dollars. Like, you've already been taxed on that. And that, to me, I don't love getting taxed on something I've already been taxed on. And we could go over and over on that one, but we're not going to.